I placed a bull put credit spread on Intel, 33.5. The stock's at 34.92. It expires on 10/27, but I'm still seeing a loss. What factor needs to be considered, like implied volatility, etc.? Here's your problem. It's right there. You entered a bull put credit spread and you have 5 days to go, technically. Come Monday, CC, you'll have 5 days to go. The stock's at 34.92. You might have entered this position this week. You might have entered it 2 weeks ago. It might have been 3 weeks ago, and you're out of the money and saying, why can't I close this position for a gain? And you had mentioned like implied volatility. Number one, in our opinion, and we reviewed it and we looked at the default searches earlier for bear call credits and bull put credits, never trade a credit spread or iron condor when you have earnings coming up between now and the expiration date. Number one, too many events could happen on 10/26 after the market before 10/27 if you haven't closed it then, where what you thought was going to be a profitable trade can now be a 100% loss in an instant. Even if this earnings was on 10/23 on Monday and Intel pulled back to 31.10 for a poor earnings. I know that's a significant move, but if it drops to 31.10 because of the earnings, that put position is going to be at 100% loss. Don't take the chance with a leverage spread trade of having the spread open through an earnings event. But your implied volatility is also killing you right now as well. Why? Because the implied volatility of the options that you're talking about, let's go take a look here. I'm going to link to the option chain. Sorry, I did that fast. I went into the quotes page to see when the earnings were coming up from Intel because that was my suspicion why you're not seeing a profit. Let's go to just the put chain for your expiration of the 27th. And the current implied volatility range, 88, 93, 90, you're at the 30, I apologize, 33.50 and 33. So those are these two. Over the life of this option, the actual implied volatility range, which I have selected here, it's not a default column, but I added, has been from 0.3771 to 0.7224. Current implied volatility is 0.6985. So you're at 93 and 90% of the implied volatility range of this option since it was released on the market. Why is that important? Because these are not likely to drop at all until that earnings date on 10/26, until after the event. Which means even if the stock moves up a little bit more, Intel moves down a little bit more in price, moves up to 35, 35.20, 35.30, or it drops down to 34.50, 34. Yeah, you're going to see the prices increase. But the time value that it's going to cost you to buy to close these positions where you're expecting a profit, you're not going to see because it's going to keep in this upper implied volatility range until that earnings event. If you didn't have earnings between now and expiration, and these two implied volatilities were at the norm of about 0.38 or 0.39, you may be able to close this position for 20%, 30% of the expected profit. Wednesday of next week, it might be 60%. Come Thursday, it might be 80%, where following the 80-20 rule, you could close it early. But no, not with a stock that has earnings coming up between now and expiration, even though you're only 7 days away. The IVs are going to stay up in this higher range of their total implied volatility range for the options. You're not going to see a reasonable buyback cost or reasonable decay in the time value to close these positions until that earnings event passes on 10/26, which means you might see a sudden gap down in price CC and be in trouble on your bull put credit spread instead of being able to close early for a profit. You sold into a high implied volatility, which might have got you a better premium than you normally would have in Intel, but that was because of the earnings coming up. That also means until the earnings, these implied volatilities are going to stay. You're not going to see the decay in the options you'd normally expect because the IVs are going to stay in that high range. Will you get assigned? You have the potential to always be assigned on a bull put credit spread or a bear call credit spread if the event happens and the stock falls below 33.50. Okay? Anytime the stock is below the short put strike price, you can be assigned. Doesn't happen that often, but come Monday morning, I apologize, CC, come Friday after the earnings on 10/26, Friday morning at 10/27, if the stock's down here at 32 or 31 because of a poor earnings, your 33.50 put's probably going to be assigned, but then your broker's going to exercise your 33 long to cover the short obligation of that put option in that case. and you'd be out with the maximum loss on the position. So should you exit on Monday? Again, I can't give any direct advice on a given position. I can only tell you that our preferred approach is we never trade credit spreads, no matter the probability, no matter how far out of the money, going into an earnings event. We talked about how you're not likely going to be able to close for a profit on Monday, even though you're expecting some time decay, because the implied volatility is going to keep those prices inflated, where you're not going to see the profit you were expecting as you would on a stock with the lower volatility range in that case. So I can't tell you what to do on the position. I can just tell you why it's not showing you the loss that you're expecting, why you got a good premium to begin with, because earnings is coming up before the 27th expiration, why that position probably looked appealing. Intel typically is not going to see a 10, 12, 8% movement one direction or the other, but remember, it always can. That's why we call them earnings surprises, CC. So I can't tell you what to do on the position. You have to do what's right for your portfolio, your risk tolerance, and your target goals for the position, or limiting target losses on the trade itself. The position could work out perfectly fine, but you're not going to see a strong buyback profit that you might have been expecting, even though both of your options are out of the money, even on Thursday, all through Thursday's trading day, because everyone's anticipating and the options are priced based on that activity that's going to happen on the 26th, on that Thursday, before Friday expiration, after the market closes. Today's material are my thoughts and your questions, designed for educational purposes, increasing investing performance and options investing knowledge. Any stocks or options discussed today should not be taken as recommendations or direct trading suggestions. Options involve risk and may not be suitable for all investors. This is why we talk about protection, hedging, and so forth. Today we had a chance to look at the function of the search tool, the market sentiment tool, search by symbol tool, running through the option chain, rollout opportunities on the portfolio, and more. If you like the tools that you saw today, remember you can take your free trial at any time. Just go to poweropt.com, put in your name and email address. You'll have full use of the tools for 14 days, including the 3 months of back testing that I showed you earlier in our bear call credit versus bull put credit spread discussion. No credit card is required. You don't have to put in a credit card, just your name and email address to access the tools for 14 days. After that, subscriptions start at just $50 per month for the end-of-day data service. The data is only updated at the end of day, 4:15, 4:20 p.m. Eastern Time. The upgrade to that is the delayed service, which is $70 per month. You get access to all of the tools and the picks of the day and the search results by email as well, with the data being updated every 12 to 15 minutes or so. The historical service, that includes everything on the delayed service, but full access to the 6.5, 7 years of historical data we have for back testing, as we showed earlier. That's only $30 more at $100 per month. And of course, we do offer the real time, and the premium service includes everything. Free coaching is available on all levels of subscription. There's 30 to 40-minute phone conversations we just mentioned for CC. No contractual obligation. You can cancel at any time. You can also upgrade your account at any time. And as we showed, you'll have full access to the webinars as a subscriber, and the full unedited with all my foible presentation for today will be posted for Power Options subscribers on all levels of subscription under the requested topics tab in our webinars section at about 7:30, 7:35 p.m. Eastern Time. Now, you can check out those archived webinars at any time. Some of them are only available for full subscribers, but the first 5 or so, there's a variety of different webinars over the years that you'll still be able to access, even on the trial or even not being on a trial, and navigating to the webinars page. Of course, you can also go to the YouTube channel, do the search that we showed earlier to look for specific topics, or check out those playlists for the various strategies as well. Now, if you think of any other questions at any time, please feel free to send us an email to support@poweropt.com and support@radioactivetrading.com. Of course, you can also call us during market hours at 302-992-7971. Trial members and subscribers, of course, remember you can schedule a free coaching session at any time.